Hello, welcome. Good afternoon to those of you who are on the East Coast. If you're elsewhere, good morning or about to be afternoon. Either way, we hope you're having a wonderful day. If you're like me and you're not done buying gifts, well, I wish us all good luck. Anyway, welcome to Logically's CFP Continuing Education webinar. Impact of volatility. My name is Steve Sullivan, and along with my colleague Lindsay Toole, we're excited to spend the next hour with you today. Just a brief note here, as you may have seen, our webinar chat is open. We're the conversational type, and as such, we welcome your questions and comments throughout the webinar. All you have to do is click chat at the bottom and send a message off to us. There'll also be a Q&A at the end of Lindsay's presentation. And certainly feel free to submit whatever questions you may have about what you've seen either from me or from Lindsay. Aside from handing out CE credits like Santa fills stockings, we're going to talk about the impact that volatility has in the markets, client portfolios, and how to find low volatility fund alternatives that can work toward calming frayed investor nerves. This webinar wouldn't be complete without bringing compliance into the conversation, as I'm sure everybody can appreciate. On that note, I'll throw a little disclaimer out there. This webinar is for informational purposes only. You should not construe any such information or other material as legal, tax, investment, financial, or other advice. With that said, let's get to it. Now, before I dive in, I want to give a brief overview of Logically and why we do what we do. I'm going to start with the why. That's the most important part of all of this. We empower and inspire confident outcomes. We think logically. This is important because this is what you do for your clients too. You're building relationships with them. You work together and partner with them to empower and inspire confident outcomes with them. The more confidence the client has in you, the more likely they will welcome your advice. And the more they welcome your advice, the longer they're likely to stick around. And that's the name of the game. So at Logically, we built a platform that financial advisors and RIAs use to automate, simplify, and streamline portfolio management. This means that you have more time for finding and managing client relationships and less time on time-consuming tasks like portfolio management. You gain a competitive advantage by using institutional-grade technology that creates customized portfolios in less time than ever and without institutional-grade overhead. That's a key part of this, obviously, is the cost of what you provide to your clients. Moving through this, it's no secret that the markets loathe uncertainty. Any view over the last, 22 months or so will show you that. Heading into 2022, off the back of a strong 2021, and that followed a rather remarkable 2020, there are numerous potential market headwinds that people are talking about. Valuations can continue to surge higher, and as does concern about those historically high valuations. One notable ratio or statistic that we often hear mentioned on CNBC and other media outlets is market cap to GDP. Today, this sits around 1.9. At the height of the dot-com bubble, 1.4. Over time, it's averaged 0.8. So you can see the translation of market value from a historical perspective. Now, we're not suggesting that there's a pullback based on this metric alone, as a catalyst is needed for that to pop the balloon, so to speak. That said, if a catalyst does arrive, like some of those outlined on this view here, mean reversion could be painful, and that's likely putting it mildly. So obviously, as we continue to see Omicron and other ongoing threats, talk about further restrictions and the impact to economic growth. Those are things that are potential headwinds as we head into the new year. Along the lines of valuations and the historic rise of valuations in the stock market, what you see here is rising valuations of the S&P 500 that shows an increasing dependence on market leadership. The PE ratio of the top 10 companies in the index sits at about 29 times compared to the rest of the index at around 19 times. Also related to this market leadership position, the top 10% accounts for nearly 29% of the weight of the S&P 500. Lastly, but certainly not least, market leadership is contributing. Again, the top 10% is contributing 28% of earnings for the S&P 500. Clearly a dependence on leadership, which is driving valuations higher and higher. Related to that is the issue of what does the spread look like between firms that are in the S&P 500. The top 20%, as this shows here, this graphic, the top 20% of stocks currently sit at about 19%, whereas historically, it's been around 11%. And this is showing a widening dispersion between valuations of stocks at the 20th percentile and the 80th. Another source for potential concern, and something that, again, you hear the talking heads speaking to. Moving into this slide here, we talk, this illustrates volatility and correlation of volatility across asset classes. Not surprisingly, what you see here is that equities have the highest annualized volatility. And again, going a step further, not surprising that emerging markets show the highest volatility in the mix. But what it also points to is the potential for a significant pullback if volatility increases with a catalyst along the lines of an Omicron or something else that hits the markets. This is an interesting slide here. There's a lot going on here. So I'll just lift some of the highlights out for you. Clearly a busy picture, but what this is showing you is that volatility, there's volatility over time, and it's often event driven by things that we qualify as black swans or other things that are just jarring to the market. Historically, over time, there's been a few more 1% upside moves than 1% downside moves, roughly about 4% more. However, and an interesting sidebar to this is over time, there's been far more 2% downside moves than there have been 2% upside moves. This is roughly 11.5%. And what this shows a couple of different things. One, that when the markets react negatively and volatility factors in negatively, it's a more aggressive and more often those moves take place. This also, what you see here, also shows how difficult and trying volatility can be for investors, particularly if they're looking through a short-term lens. This also depicts and shows over time, the graph alone over time shows the power and value of staying in the market over the long term. The caveat to that, obviously, is we don't know how long any individual client has that they can a reasonable investment horizon for each client. It's going to be different based on numerous factors. So some of the argument to stay in the market to overcome volatility in the long term may or may not be at play. And I'd be remiss in talking about volatility without a mention of COVID volatility. And I think that what you see here is that pandemic fatigue aside, it shows how event-driven volatility can really dramatically alter market returns. When you look at volatility in 2020 in this chart compared to 2019 and 2018, significant increase in volatility. And prior to and during the cliff dive from the markets between February 19th and the 23rd, as noted, roughly 34%. The VIX, this is an interesting number here. The VIX moved from 14 on February 19th to a peak just about a month later on March 16th of 82 before, I guess what you'd say is settling on March 23rd at 61. Just huge moves in the VIX. And obviously we can see the correlation to that and how it exacerbated the conditions and then downside to the market. This particular illustration shows a couple of different things. And the reason we include this is because it's not just the event itself. It's not just the volatility itself, but it's the ability to weather the storm over a period of time. And here you can see these events over time and the impact on performance, highlighting the importance of having time to recoup losses. The COVID example from the previous slide, a little bit different because the snapback was so significant and fast, one of the fastest market recoveries in history. But this also highlights the importance of quickly finding lower volatility funds for clients who fit a couple of different profiles. One, that they're focused on capital preservation instead of growth. Two, they may be anxious about what they see or consider to be whipsawing markets and continuing uncertainties. They talked on CNBC today about not sure what's coming behind Omicron and in particular, the travel industry's ability to withstand that. A third particular client profile that this is relevant to, as mentioned, clients who don't have the luxury of time to wait out a big downdraft. And the example is, if you were to look at the first row here with the stock market crash of 87, this is 31%, but a 30% decline in your portfolio is going to take a 43% return just to get back to par. So you're talking about a significant move, and we can find them in history, but there are going to be clients who don't like the roller coaster ride, and two, don't have the time to wait out that roller coaster ride to finally settle into a smooth glide path. So to continue the conversation about how to find low volatility funds, as we've been talking about, I'm going to stop here and hand things over to Lindsay. She'll cover how easy it is to find low volatility funds and where to find those and how to piece those together in a portfolio for clients. Less time researching, more time for clients. Lindsay, take it away.
Thank you, Steve. That was a great introduction and background on volatility and what it does to our clients' portfolios and the market. So hello, everyone. Thank you for joining us. I see we have quite a few of our clients on today, as well as a lot of new folks, which is great to see. So I am going to turn it over to the platform here and kind of walk through a few ways that we can look for funds that help us reduce the impact of volatility in our clients' portfolios. And today we're going to focus on, three themes, basically to incorporate lower volatility ETFs. ETFs that are minimal volatility or low volatility ETFs being one. Quality ETFs, a lot of times in volatile markets, people look for quality or dividend, those type of names. And then right now, very timely is, inflation. So inflation protected ETFs. So those are the three that we're going to show you how to, easily find that group of funds using the Logically platform. So right now I'm on the homepage. You see these are kind of the most used tools here. But on the left-hand side, there's the toolbar of things that are available to our advisor clients. So we're actually going to go into the fund screener. It's where we're going to focus most of our time today. So we go into the fund screener. If you're not familiar, we are a global platform. So every ETF listed globally is available here. Every mutual fund in the US and Canada is also represented here. We're going to focus on ETFs for purposes of today. So in the screener here, when you come in immediately, it's going to default to global ETFs. So right now you see there's over 10,000 global ETFs listed. So we want to get this down to a manageable universe of something that we're looking for, right? So there are filters. And at the top here, I'll just go ahead and say, these are all different views that you can see of that universe, risk, returns, flows, etc. But let's get this down to something more manageable. So when we go into filters, you see there's a lot of different ways to kind of filter the universe. You can do it by issuer, you can do it by benchmark. You can even do it by certain thresholds of returns, flows, etc. So a lot here, but we're going to really focus on the general tab here today. So let's just keep this US focused. I believe everyone here is US focused on the call. So we're going to select the trading country, being the United States. And in this tags section, so this is great, and you can type in anything that you're looking for: technology, ESG, income, value, etc. And it's going to pull up that universe of ETFs. So I'm just going to start with vol. So there's volatility and vol. I'm going to select both of those. We'll start with the low volatility names of ETFs in the US, and we will hit apply. So we went down from that 10,000 number down to 43 funds now, right? So this is a little bit more manageable. And here are, again, ETFs, US listed, that have low volatility or volatility in the name. Okay, well, how do you decide what to do with these 43, right? Which one's going to make sense for you? They all say low volatility, but let's really see what the volatility or the risk is of these different ETFs. So back to the top, where we have the different tabs, I'm going to start by clicking on the risk tab. So this is going to take that universe again and then show you common risk metrics: momentum, volatility, etc. Most commonly used is the 20-day vol. So we can actually sort this chart, and let's see, of these ETFs, what really has the lowest risk. So it makes sense in this case that the bond ETF here is coming up first with the lowest vol. We've got some international names developed. But why don't we get this more where we're looking apples to apples? And so what I want to do is actually go back to the tab, the general, and just make it look at equities. So let's just say we want to look at equities and compare maybe two equity funds. So I'm just going to select equity here in the asset class. This just takes out a few of the funds, and now we're down to 39 funds. And we'll sort again by the volatility there. So we've got IDLV and Invesco IDHD. So let's choose two that aren't the same issuer. So there's a lot of options here, right? You can actually click on this, go straight into a security overview, which I'm going to show you guys later to see an overview of that fund. You can create watch lists. So maybe we want to create a low volatility ETF watch list. You can add to your watch list. You can compare, which is what we're going to do. So we can compare two funds next to each other to see, okay, which one do I want to go into based on the additional metrics that are available in terms of exposure and performance, etc. There's also another tool, which I don't want to fail to mention, which is the fund compare, where you can do more than two ETFs or funds. But let's just pick, let's say, FlexShares QLVD and this first one, IDLV. So I'm going to go in here and hit compare. And it's going to bring you to what we call our side-by-side tool. And this is actually can be used for portfolios as well as just individual funds or securities. You can create on the fly, add as many securities as you like, you can upload portfolios and compare them, et cetera. But right now, we're just going to look at these two ETFs, these two low vol ETFs. I've already loaded QLVD. So here, you have the option to set a benchmark. The benchmark is not really relevant for us right now if we're just going to look at these two side by side. And then I'm going to hit apply. Okay. So now you're going to see these two funds side by side. Standard metrics, right? They look about the same size in terms of AUM. Actually, IDLV is much cheaper than QLVD. IDLV has been around a little bit longer. Core focus for IDLV is financials versus healthcare for QLVD. So it'll be interesting to see what the performance looks like. So here we have, I'm going to take out that benchmark, the historical performance. And you can see, before, mid 2020, they were kind of in line, but now QLVD, which has more of that healthcare exposure, has really taken off compared to the Invesco version, which has more financials, as you see here in that sector breakdown. So this is giving you, a due diligence tool, if you will, to make those decisions on what, fund you want to put into your portfolio. And the great thing about this, there's a lot more here I won't go into today, but you can PDF any of this. You can customize it to have your logo. You can write notes or document notes about this particular report and why you chose, let's say, QLVD. And it always saves into the platform in our document center. So it serves as an audit trail. It serves to help with Reg BI to concretely say, back up for why you made a certain decision. And then also it's nice and pretty that you can present to your clients. And again, this can be for portfolios or just funds. There's quite a bit here. And again, right now I'm just looking at side by side, but there's also a fund compare where you can do multiple funds at once and compare. Okay, so let's go to another way of looking for lower vol ETFs, not just by looking at the name. So I'm going to go back into the screener here. And we're going to keep it, we're going to take out the tag that we used before, which was the volatility vol tag. So I'm just going to X that out. That goes away, resets filters. Again, we'll just concentrate on equity in the US. And back to the filters, there is a section called rankings. So this is really cool. So this takes the entire database, the universe here, and it's going to decile out the highest volume ETFs or funds, for example, or definitely ETFs in that case, the lowest expense ratio, the best performing, the lowest volatility, highest income, most diverse. So we want to look at, let's say, the lowest volatility fund. So we'll put the top 10%. So if we put 9, it's going to decile for the top 10%. I'm going to hit apply here. And we're going to get another universe here. 1 second. Looks like it might not have saved. 1 second. There we go. There we go. So now we've got 45 funds here. This is the top decile of lowest volatility ETFs. You see, basically none of these have volatility in their name. But they have the lowest volatility across this universe. So if we look at, let's go back to that risk tab. And again, we can sort by that 20-day volatility. And we see, okay, we've got some new players we didn't see before, right? Some defined wealth shield, mortgage back, interesting ones to take a look at. One thing that you can do as well, if we just want to look further, I mentioned this earlier, if we just want to look further into any of these ETFs, we can click right here that takes you to the overview. I like to show this because this page exists for every global single stock, global ETF, and then US and Canadian mutual funds. So this is more than you'll find on the actual sponsor's website in terms of, okay, the profile, we're doing calculations for you, max drawdowns, upside downside capture, a lot of the stuff that you like to see or clients like to see, returns, trading statistics, etc. So this page again exists for every ETF, so you can, or fund. So it's a way to kind of drill down. If you see these 43 funds and you don't really know what they are, this is a good way to do it. Okay, so we did low vol in the name, we did volatility ETFs by ranking. Now, the other theme that I mentioned was quality. So we're gonna do the same thing. We're gonna just take out these different tags and we're going to add in a tag for quality. So back in the general again, we'll still keep it on equity US ETFs. We'll type in quality. And we'll see what we get here. Okay, so now we've got 47 funds that fit in this quality bucket, if you will. And again, we can sort by the volatility. Sorry, yeah, I did that correctly. So this first one, right, the American Century Quality Preferred, this 4%, that's less than any of the funds we've seen so far, or not, well, not necessarily the lowest vol, but of the volatility named ETFs, right? So we've got quite a few here to explore. Again, you can do the same thing, comparing, putting them into the fund compare, examining them further through the security overview. And then of course, looking across all the different views is just a nice way to look at it. Maybe we want to look at flows for these names. We can sort here by, let's say, year-to-date flows for these quality names. See what's getting the most iShares quality factor, Invesco's quality, DGRO, which is a dividend. So yeah, dividend usually falls in that quality bucket. Okay, so the last theme was actually looking at inflation protected, or TIPS, Treasury Inflation Protected ETFs. We've actually seen quite a few of our advisors move in, take some of their exposure out of traditional fixed income into TIPS just here recently. I expect that to continue. So we actually created a filter for TIPS. Sorry, real quick, I'm going to take out the filter of quality here. I'm going to go back to our filters, back to general, back to the tags, and do TIPS. And actually, I need to take off equity because they're fixed income. So make sure to take off the asset class in that case. So here we have about 11 US listed TIP ETFs that you can explore. Again, looking at different metrics, volume. Let's see. Everyone knows TIP US. Looking even the rankings again, as we talked about before. So as opposed to just using rankings as the filter, you can use rankings in this view to then see where they rank on certain which decile they rank in for those different variables there. So we could go, let's go back to that risk column real quick. And we will sort again on volatility. Yeah, so we're seeing much lower numbers here. And again, you can do the same thing. You can create your watch list. You can explore further. You can compare a lot of things that you can do here. You can also download any of this to Excel. So I showed you pretty quickly a few different ways to find at least those 3 different themes that we talked about to help reduce volatility in your clients' portfolios. I think we have time to do more or open it up for questions. I'll leave it to you, Steve.
Yeah, sure, Lindsay. Thanks. That's excellent. Yeah, so as mentioned, our chat window is open, and I'll direct you there for a moment. As with the webinar we're hosting, talking about volatility and showing how to source low volatility options for your clients. We've posted in that chat a link to a special webinar offer. It's a free trial of the platform, so you can take a closer look, screen for yourself and for your clients. But we did have some questions that came to us, Lindsay, so I'd like to go through these. First question, within the fund flows tab that you touched on a moment ago, how can I see fund flows by peer group?
Okay, that's a good question. I actually didn't go into the fund flows tool yet, but you probably saw it when I pulled up the toolbar. But let's look at the fund flows, for example, if that's of interest. So in our fund flows, we have a few different ways to view flows, again, globally or by certain regions. So let's just look at US. And you're asking about peer groups, so to see where flows are going, let's say healthcare or large cap growth, etc. We can select the peer group here. The look back period, we'll just look at year to date for simplicity now, and we'll hit apply. And you'll be able to see the AUM and the flows. This first tab is just by asset class, but then by peer group is what you're asking here. This is the AUM by peer group, technology, fixed income, corporate, government, etc. The AUM, I'm going to show you also the growth in AUM by the peer group, and then the flows by the peer group. So we could sort, it's already sorted year to date. So top, North American equity broad, and further. I think that's what answers your question. And again, any of this can be PDF'd and again saved as well to nice reports.
Okay, so you had another question come in, Lindsay. When creating a new portfolio, how do I set a benchmark? And can I pick a benchmark that best fits my needs?
Yeah, so that must be from one of our existing users. I appreciate that. We haven't really gone through portfolio analysis on this presentation, but we can click right here into portfolio analysis. So this is where you can upload portfolios, create portfolios. If you're with Schwab or Redtail, you can integrate your portfolios. They will always exist in this section here or in your My Portfolios. To set a benchmark, so we do not have index data, so it's not index related. A benchmark can be a single ETF, it can be a combination of ETFs, such for example, the 90-10 SPY Ag or 60-40 SPY Ag, or anything that you want to create. Any portfolio that you've created can be used as a benchmark. It can be a mutual fund, it can be a single stock, anything. You can also just default, again, to say no benchmark or have us automatically select it, or do it 60-40 or 90-10, 10-90. So it gives you a lot of optionality of what you want to use as your benchmark. And again, it's not index data, but an ETF, combination of ETFs, mutual funds, portfolios can be used as a benchmark. Hope that helps answer that.
Hope so as well. So again, opening up to questions. If anybody has any questions, please feel free to submit them through the chat. We're happy to answer whatever questions you may have. And again, just to draw your attention back to the chat, there is a link in there for a special webinar offer. It's a free trial sign up of the platform that you've seen Lindsay walk through. So we'll just leave it out for a second. If there are any other questions. In the meantime, Lindsay, is there anything else that you feel is worthy of mention that maybe we haven't covered?
Yeah, one thing actually, if I go back to that fund screener, one thing I did not mention is that you have the ability to create your own custom views. So as you see, there are pre-plated, different views here, but what if you want to take, a column from volume, a column from returns, a column from, income, et cetera, and create your own view of things that you want to focus on and you want to see on a daily basis. You can create your own custom views. So these in blue are actually custom views. So to do that, you click add and basically you type in, or you can find what you're looking for. So we know we like that risk, that 20-day volatility number. Say we want to include a return, say year-to-date return. Probably want to include maybe something on income, the trailing 12-month, maybe something on flows. So you kind of type it and you then create, what you want to look for on an ongoing basis, expense ratio, maybe rankings, anything that you saw in those different tabs, you can create your own view. And then you can move these around in different orders, save it. And then it will always appear when you select it. And that's the view that you can see your funds in, or the universe you've selected in. So I think that's something, I know I use that quite a bit with clients creating their custom views.
Okay, that was great. So we just have a few more minutes here. If anybody has a question, again, feel free to submit through the chat, and happy to answer. As we close out the session, just want to say on behalf of the Logically team, myself and Lindsay, thank you for joining us today. We appreciate you taking time with us, and we hope that you found the topic interesting, engaging, and applicable to what you're doing for clients today. As a token of our appreciation, we're handing out CE credits. No Grinches. Anyway, thank you also for your questions today. As an advisor tech company whose strategic product roadmap is largely driven by client feedback and input, and that from our partners as well, we're grateful for questions we've had from you and continue to get feedback along the way. It really lays things out for how we advance the platform to innovate for you and for your clients. Last but not least, we hope your holidays are peaceful and enjoyable, and we wish you a happy, healthy, and prosperous new year. Lindsay, anything else?
Yeah, no, thank you guys so much for joining. Happy holidays, and I'm happy to walk through this with anyone who's interested. You see my email right here. Me and my team could set up demos, walk through. Obviously, there's a lot of tools there. Happy to help you. And as Steve mentioned that we do value the feedback that we receive from our clients in terms of making our platform better. So please reach out if you haven't already, and we will talk to you soon. Merry Christmas and Happy New Year.